All right, in this video, we are going to have some fun and look at a case study of a 50-year-old individual funding a policy for 15 years at $100,000 per year. We've got it all designed for maximum cash value, 10/90 split with one of the major mutual companies. But what's going to be different about this case study is what we're going to demonstrate is what if life happens and he can't pay anything into the policy anymore. So he had a plan to pay into it at $100,000 per year for 15 years, but life happened, oh man, and he has to stop payments altogether after 3 years in this example. I say to him, hey, no problem. We designed the policy where you had about a $10,000 minimum premium. You can easily pay just that. And he says, no, you don't get it. I can't pay anything. Everything has just come to a complete halt in my life. What's going to happen to my policy and to my money? So if you've ever had that concern, we're going to go through exactly how it will be okay and why it will be okay if the policy is set up properly. But then we're also going to look at what if life happens and then life happens again, but for the better. Oh yeah. So we're going to look at an example where we max fund it for a few years, the 3 years that we mentioned earlier, but then we don't stop but reduce to a very low amount, about $20,000 per year. When I say very low relative to what he's paying in. And then all of a sudden, life happens for the better. And he says, hey, I came into a windfall. I've got a big pile of money. Can I add it to my existing policy and make up for some lost time? The answer is yes, by making a large MEC catch-up payment. So we're going to show you exactly how that works. We've modeled it already. We're going to take a look. So let's begin with the first example. We've got $100,000 per year going into the policy for 15 years. And this is a policy designed for maximum cash value and really how we can tell what to look for. If you've ever looked at high cash value life insurance policies, here's exactly what I want to look for. With a detailed illustration, this will be broken down. So we've got $100K going in. Of that $100,000, the base premium is about $10K. It's a little bit higher in this example. It's closer to $10,600, $10,700 just due to his age, but we've got it very close to that minimum 10%. And then we are just plowing funds into PUAs as close to $90K as possible, a little bit lower because that's a bit higher. We've got a term rider attached as well. But really what to look for if you're looking at a basic chart like this and not the detailed illustration, year 1, 86%, breaking even. Year 5, just about year 5 in this example, I've paid in $500,000 and I've got $499 and change. We can often get that to year 5, no problem. But here's his plan. To pay in $100K per year, a total of $1.5 million into a high cash value life insurance policy. He says, this is my goal. This is why I'm doing it. The death benefit, that becomes more and more valuable to me as time passes. But right now, Steve, I'm interested in this. Maximize this for me, short-term and long-term. Short-term because I'm a business owner and it's an opportunity cost to me. So we do, and we set it up so he can pay into it for 15 years. And he can bounce those payments up and down, no problem. But life happens, which it happens to all of us, and he has to stop altogether. Have you ever had that situation where something comes up and it's just like a screeching halt? Hey, I can't pay anything in, but I've already committed. So if I could go back in time, I would not have started this, but I already did. So what's going to happen now? Now this assumes no loans are outstanding, which we've got other content on that. But here, funded it for 3 years, so he's $300,000 in, and then he stops altogether. So a couple of things I want to mention here is in this particular example, he still has a $10,000 base premium, a little bit more than that, that's due each year, years 4, 5, 6, 7. What's happening here is that $10,000 premium is due, but it's being paid internally by the policy, not through a loan in this case. It's being paid through dividends and interest. So the insurance terminology for that is what is called or referred to as a premium offset, where you are allowing the dividends and interest on your policy to pay the premium for you. That's what he's allowing to happen here, or that's what he's doing. You'll see a death benefit decrease right here. What we did here is cut the term rider, and you'll notice on the example on the left, we did not do that. because we were still funding the policy each year. So we did not want to cut it because we didn't want to run into a mech. Here we're not doing that, so we just cut the term rider. And then in this example, you'll see another drop at year 11 after the age of 60. Why the death benefit drops here is we executed an RPU, which stands for reduced paid up option. So really years 4 through 10, that base premium of 10K was still due in this example. He's not paying it, it's being paid internally by the policy, but I do like to refer to that as drag, meaning before dividends and interest are kicked back into my cash value, first they have to cover that premium, which is a form of drag no matter how I slice it. But the cash value still appreciates, and I do like to stress test these scenarios based on guarantees as well. But here's a worst case scenario. I can't pay anything in, and what happens to his value continues to appreciate. Break even, still between years 5 and 6. I often stress, not so much in our videos, but when I speak with individuals on a regular basis who have a concern of life happening, even if they've got a lot of cash on hand, this is a common concern because if you've worked really hard to build things up over time, you know how quickly that things can go away as well. What you'll find with a cash value life insurance policy is if you juice it, and when I say juice it, 10x the base premium, max fund it, if you get through the first and second year, in most cases, you're in a great position where even based off the guarantees, you'll see it continue to appreciate over time. Assuming we pull all the proper levers, term rider reduction, reduced paid up after year 7, and once you go reduced paid up, you can't add anything in after the fact. So that's a conversation we have too, like, are you 100% done? If you still want to continue to, you might want to continue to add funds, then we won't do that yet. But that's a conversation we have with individuals. Anyway, now I'm talking a lot here, going into extra detail. Let's progress on to the better life happens scenario. So life happens, but we say, you know what? I don't have to completely stop. I can pay a little bit more than the base premium. I know my plan, Steve, was to pay $100K per year for 15 years. I got it in for 3. And you'll notice, check this out, in all 3 examples, these are identical. The reason why, it's the exact same policy. This was actually a case study I put together for one of my mentors that helped me early on in my career, and I still talk to him on occasion. I really enjoy speaking with him. But I was going through catch-up payments and why one company has a particular advantage and he can model them. He goes, you know, I'd like to see that. So I put it together, and actually I put this together in the software. So I sent him the recording of me going through the insurance company software and then making this huge catch-up payment. And he's like, all right, that's pretty cool. I've never seen that before. Like, how do we do that more? Anyway, that's me having fun, like what I do in my spare time, model policies and send it to my friends. I'm kidding. All right, so exact same policy through year 3, and then I kicked the payment down to $20,000 per year through the 9th year, but then life happens, that oh yeah scenario, the little doodle I had, the guy with the smiley face, year 10, $400,000 payment in. Now, what I'd like to emphasize here is that his base premium is still $10,000. The maximum split this company allows is a 1090 split, meaning we can 10x the base premium for a total of $100,000 per year. If you try and go higher than that, they kick the illustration back when you send it for issue and say, you got to redesign this. We're not approving this for sale, with the exception of catch-up payments because we're making up for lost time. Have never run into an issue with this, and we've had a lot of people do this over the years. So this does not make up for all of the lost time, but a $400,000 catch-up payment plops right into cash value, and then he stops payments altogether. You can see the death benefit drop at that point in time. We executed a reduced paid up option, cut the term rider, no payments, cash value keeps on growing. The thing I like about this is it demonstrates your ability, if you have a policy, to adjust payments as time passes. Meaning when you start a policy, are you committed to the exact same payment forever? $100,000 per year, I keep paying it every year, it's a bill, I'm committed to it? Or can you bounce payments up and down over time? The answer is yes. If life happens here, or I've got to stop altogether, you can easily do that if it's set up properly. This is critical in a case like this, and we can wrap up with this point, is if you have a high base premium here, let's assume we were paying in $100K per year, but we had, say it was even 25% or greater, that's where this would be problematic, because we've got a high insurance expense that now needs to be covered internally by the premium. If it was 40%, that is way too high. This would not work, especially based on the guarantees. Those values would decrease and a policyholder would begin to lose money. So this is really where I do like, if an individual's goal is maximum cash value, that low premium close to that 10% ratio, in the majority of cases, not all of them, but the majority of cases, that provides a lot of flexibility for the individual. And if life happens, we're protected in that sense, that the policy can still appreciate even based on the guarantees if I've max funded it for a couple of years. So a couple things there, just protects a policyholder from life, when life happens to all of us. And why I said the majority of cases with that minimum premium design is depending on the company and product. Sometimes it does make sense to go with the higher base premium. Some people we've worked with have done that, meaning we don't sell 1090 splits to every single person that we work with, though the majority of people do move forward with that after seeing all of the options. Anyway, hope you enjoyed that one. I had a lot of fun with it. If you did, please hit the like button, subscribe for more. If you didn't like it, let us know. We'll always aim to improve, but I do hope this helps, and we'll talk to you soon. Thanks again. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.